Evening, ladies and gentlemen. Pleasure to have you here. What time are we? 7 o'clock on the dot. Let's get going. This evening, we're going to cover trade management. How rude of me. How are you? How are you first? I hope you're well. I hope you're navigating these market swings, doing okay, or at least, not doing too much damage. I don't ask you enough how you are, and I hope your trading is going all right. Anyway, this evening, we're going to talk about trade management tactics. Hopefully you can see my screen, you can see me, you can hear me all loud and clear. We are 2nd of December. How many days until Christmas? I don't know. It feels like it just jumps up on you like Christmas. I hope you're doing your Christmas shopping. Don't leave it to the last minute. I used to do that, like 24th of December, go right, and then you just go into the department store, don't you? And you go, I'm leaving things to the last minute, and they go, sir, step this way, we have just the things for you, leaving your shopping to the last minute. How about this? And they wheel out something super expensive, and you go, you know what? Supply demand. I've got a couple of hours left, and you have to buy that. So be smarter about your Christmas shopping. Anyway, enough about Christmas shopping. Pleasure to have you here, ladies and gents. My name is Mark Holstead. This evening, we're going to talk about trade management tactics. So what we'll normally do with this, if you're new here, if you're not, a reminder of what we do, we'll go to the screens, we'll talk a little bit about the markets, what's been happening. Not too much, because I know you get that stuff elsewhere, but I just want to kind of keep in touch with things and share my thoughts on a few things specifically. I've written them down that I think are going to be valuable to you. Then we'll go back over to the slides and we'll run through. Really what I want to get over this evening is the ability to manage the trade effectively. Now, I say that with caution because, listen, I live in the real world, as do you. There's no perfect formula for trade management. There's going to be times when you try to run trades that come back on you. There's going to be times when you scale out and you shouldn't. You're never going to get it right 100% of the time. But the issue, I think, with many traders is the psychological damage that we often get when we are chasing our tail. Because many of you got the entries dialed in, you got your strategy dialed in. There's a few tweaks to be done and what have you. But ultimately, this is just another piece of the puzzle that helps you in a lot of aspects. Helps you run the winners when they're there, helps you kind of work out when to scale, when to trim, when to trail, and also the constant anxiety that you can feel as a developing trader when you're managing a trade, like, should I close it, should I close it, should I close it? That little voice, we're going to try and get rid of that. We're going to try and come up with a process that will help you manage your trades more effectively. Like I say, no holy grail, no silver bullet. By now that's not how it works trading, but hopefully a guidance that serves you more often than not, and that works out in the wash as sort of much more edge over the long term. Okay, so trade management tactics, here we are. I should also let you know, ladies and gents, of course, you see that we've got, I have to tell a disclaimer, you know this by now. If you're trading a spread bet product, you're trading a CFD product, any instrument basically that's trading on leverage, then just be aware of the risks involved in trading that instrument. If you're right, it's great, whoopee-doo, everyone makes money when they're leveraged up and things are going well. And when they're not going well, that's when things can turn. Losses can magnify very, very quickly. You can become a deer in the headlights syndrome. You can get caught out by surprise news, and losses can happen fast. So not only from a kind of operational perspective of P&L getting decimated, but also from a mindset perspective of, hey, whoa, this is a bigger loss than I expected. So just make sure you're trying to do the best thing you can in terms of risk management, stop loss, low position size, understanding gap risk, understanding slippage, understanding when the spread widens, because it does sometimes over news, that type of thing, regardless of who you're trading with. That's going to happen whether you're, what instrument you're trading as well, liquidity for that instrument. So just please understand the risks in trading and do what you can to manage those risks. And one thing also, I guess I should say is, if you're the type of trader who's taken a few risks maybe that they shouldn't have and got away with it, just say, thank you, I got away with it, market gods. I won't be doing it again, because it only takes one time when you take way more size than you should do, perhaps over news, over earnings or whatever it might be, and get caught out. And that's it, man. Capital is a tool that you need to thrive in this business and survive. So protect that at all costs. All right. One thing else I wanted to show you before we get to the charts is this book. You can see this. Now you might be like, Mark, I've seen Reminiscence of a Stock Operator many times before, and you're quite right. You have. However, I forgot I had this version. So this book, I just knocked the microphone in my face. This version is a hardback version, and this annotates and gives you different snippets and explainers about what Jesse Livermore's talking about. So Reminiscence of a Stock Operator talks about Jesse Livermore's life. Jesse Livermore was a great trader. His ending wasn't so great, but he had some great trades along the way. And this book gives you kind of little annotations on the side to explain what he's talking about. So some of the terminology for the 1930s, some of the things he's saying, and also including some kind of modern charts and images and kind of little even snippet newspaper clippings. I forgot I had this. It's on my bookshelf and I just walk past it every day. But I'm going to dig into this because there's some things that are just nice to have a bit of context and color on. I know you guys like books, so I thought I would recommend that. And this is a little bit dog-eared, not because I've read it much, but because I dug it out ages ago from my garage bookshelf. What I thought, in the office, and I've forgotten about it. I'm going to read that anyway. I thought I'd mention it. Let's go to the markets, have a look what's been going on before we go to the topic of the day. Okay, so Nasdaq trades pretty well, right? We had this good drive higher, and last week I'd mentioned this is I think the high of this level is important and the low of that level is important. I kind of bracketed these two. We've cleared that. We've had a good run. We've had one red day, which is kind of normal. And if we close near highs today, I think that trades quite well. And it maybe sets us up for that kind of rally into the year end. Obviously anything can happen. But you've got to remember that Trump wants stocks all-time highs. He said so much. We've got a good chance of a rate cut coming in, which could be a sell the news event, which would set up a separate trade. But, maybe not. Maybe it's not necessarily everything sell the news event. Maybe we do just rally hard. There's a lot of liquidity in the market, a lot of money spare, and just got to you're thinking through that. Lower rates, more money for the companies to spend, more liquidity to spend, invest, more fuel going into the economy. Other companies rising, stocks rise. That's a thesis. Of course, it doesn't always work like that. That's a thesis. So we've got that. We've got Trump wants stocks at highs. We've maybe got kind of some things simmering down with the tariffs. I'm not sure when the next date is for the next negotiations. There's all talks of income taxes being. There's a lot of bullish news now. If it all goes to plan, then that's going to mean will we close, kind of push the highs, we've got the Santa rally. The flip side is everyone's position for that, which could be a trap. Now, does that market always trap people? No, we can continue for a long period of time before a lot of people are trapped. But one thing to watch is kind of just price, right? You're a price action trader, I'm a price action trader. How does it trade? And so far, so good. I think the market overall trades pretty well. Dow's looking okay, one pullback, a bit of consolidation today. That's fine. That's the way it is. S&P 500, same thing. Big, strong drive off lows, indicating buyers saw that as value. There's a lot of negative news coming out there. We had a bit of, actually was sold off on Nvidia good news. So it was all a little bit, not sure, but actually the discount was bought by buyers and we've seen that now. So unless something major happens, we likely, again, much my opinion, I've got no idea, we probably just drift higher into the year end. And so myself, I'm looking to position accordingly for that. But anything can happen. All things can change in a heartbeat. And again, I'm not here to give you advice, it's not trade advice. You know that by now. Just my thoughts on how price is trading when I look at the daily charts and stuff. So one other thing I wanted to show you, of course, is silver. Now, I wrote about silver. I do a daily email. Many of you subscribe to it already. Thank you so much for your feedback on that, replies. Appreciate them all. As you know, I respond. This has just gone parabolic. And this is the sort of thing that, it's very much a supply demand thing. It's very much a sentiment driven. And if you go back, and one thing I'd say is, when you've been trading for a decent period of time, you go, hang on a second, I'm sure I've seen this before in silver. I couldn't remember when. I don't scroll back. I scroll back. And if you go back long enough, and you go back to 2010, 11, we had a very similar thing where silver really just ripped. Right, at the end of 2010, going into the start of 2011, it just absolutely flied. And you can see here, it went from almost hit $50. This is the futures contract, by the way, in comics. We started here about $18, and we just absolutely went to the moon. And it was this last little bit that just, you think about it, it's like the real squeezing shorts, all sorts of stuff going on. It did 20% move in that last kind of push in the bull run, but it ended very nastily. And I remember this. This price action, it was just a massive rug pull, and we had this kind of wick. It held gap. It was just a mess, and then it basically gave back 30% of its move within 4 or 5 trading days. Brutal move, brutal move. So does history repeat itself? You know what? Who knows, right? We're not here to make these predictions. However, where's the? Let me scroll away like an amateur. Where's generally speaking, when we have these parabolic moves, there's going to be an end to it, right? And then that might be, maybe it just grinds lower, but most of the time when there's this panic urge, I don't know when, I'm not suggesting that it is now, but I think there's something to watch for if you're long silver, or if you're looking for maybe a short intraday or something intraday, is to kind of watch how this trades. Because this extension, maybe you get one more gap higher, maybe you get a really big range move, and then watching how the response to that is. If it suddenly backs off and it's just a rug pull, there's probably going to be a lot of people who are caught long in this, who are trapped. Now, could carry on for weeks. We don't know this, but we see, when you've been trading for a while, you see this sort of price action happen again and again in different types of markets. And so just be aware. And if you're not trading it, it's a great one to watch. Put on your watch list, because being able to observe how the crowd behaves and the dynamics that shift supply demand, and how it can shift on a dime in an instant, is so valuable for you as a trader. If you're an intraday trader, if you're a swing trader, just watching how this behaves. Gold's lagging a little bit. I think it's because of the liquidity slightly. Okay, one more thing to look at. 2 more things actually. Bitcoin, that's a good move for bulls. Yesterday was hell on earth for them, just complete rug pull. And this is the response you want as a bull. Right now, you want to, and again, why I'm kind of sharing this stuff is this is broad price action rules that will serve you in trading. It's how does price trade? How does it trade? Does it trade well? What's the response to rug pulls like we saw yesterday? You know, this is quite a bullish response, and so your expectations are, well, do we grind back up to 100,000? Do we kind of carry on that bid because this was a strong day? Now we've got a few hours to go, of course, or do we? Or is this just a massive bull trap? And then in which case that low is the level that would be everyone's stop will be in place. I know there's some different dynamics with Bitcoin, but it's thinking through these different things based on what's happened that helps you, gauge a trade intraday. Maybe you sell the low. If we go through there and it's an A to B play, you go high probability, I'm done. Maybe if you're a buyer, you're like, hey, I want to see the first red day. I want to see a doji. I want to see a little flag now. I've got a target here. So it helps you frame out the trade regardless of the asset class you're trading. And one thing also I wanted to show you here was actually no, 2 more things. I think these are important, so I think you'll find value. Sorry, Apple's at all-time highs. Now this is a really good example. I'm on daily charts here, and it applies, whatever time frame you're looking at to a certain degree. Apple's at all-time highs here. It's not that I'm long Apple, or I've got a dog in the race here at all, or any position. But it's an interesting example of relative strength. Many people are saying, what does relative strength mean? What does it look like? When you look at the NASDAQ, and the NASDAQ had come off hard from this 30th of October, Apple didn't do that at all. Apple came off a little bit and just held. And so that's the example of relative strength where, it fell, but it kind of stayed in this range. And then when the NASDAQ bid came in, that caused Apple to go up even higher. And so something to consider if you're trading different types of asset classes, and you're looking, doesn't necessarily have to be stocks against NASDAQ. It could be any of these things that have some correlation. Looking at the market that has relative strength, i.e. how does it behave relative to its peers, gives you an insight into the true supply demand imbalance of that asset. Apple, you think about it, when the rug was being pulled across all NASDAQ stocks, Nvidia was getting battered, Palantir was getting battered, etc. Where did people not want to pull their money out of? Apple. And so what happens then when you get the rotation back up in the broader market, then the stuff that hasn't had the money pulled out tends to have money pushed back in. Just an example of relative strength. I thought it was a really good one recently. Okay, final thing, then let's get down to trade management. Where is she? Dollar yen. So dollar yen, I think a lot of people are expecting this to hit 160, and a lot of funds are positioned for that. It probably has a lot of the wind behind it. There's a lot of stuff going on with the Japanese bond yields. Fine, whatever that is. I don't want to get into all that type of stuff. From a price action perspective, this is interesting, and this might interest you. we've had a lot of times where, especially after this kind of big move that we had on the 6th of October, kind of repriced it in a way. If you look at how the duration of the rotations, so I think no one could argue here that we're in an uptrend here. You know, we've been an uptrend for a while. We're consolidation, we're an uptrend. A lot of people have kind of looking for further move. Fine, whatever. What's interesting from a price action perspective is how long the durations of the rotations are. So if you look at these here, you've got from high to low, you've got a 6-bar rotation, so 6-day rotation. High to low here, so that high point on there, you've got a 6-bar rotation. High to low here, we've had a 7-bar rotation, so close enough. That's just quite of interesting, and I've talked about this many times before. Is, you know, it's not a silver bullet, it's not a holy grail, but often getting into the rhythm of the market you're trading and seeing these little nuances. And if you're trading on a 5-minute chart, it's like, oh look, we've had 15 minutes of rotation, then buy a step in. 15 minutes of rotation, buy a step in. You know, I'm not saying that this is a particular pattern that's going to continue forever, but it's something that's interesting, right? And you kind of the best way I think to trade is to really align with the environment that you're in, the conditions you're in. And one way to do that is to kind of just use time, just use these measurements and say, well, how long did it consolidate for? How long was it between lows and highs? And you'll find this symmetry happens an awful lot. Do you want to just kind of blindly trade off it? No, I don't think you do. But if you combine that with your traditional setups, like your ignition bars, like your reversal candles, this type of stuff, I think it adds an extra layer of edge. So maybe one thing to do on your checklist is to say, hey, you know what? Actually, what I'm going to do is I'm just going to look for any symmetry. And we talked about symmetry extensions away from VWAP, often very similar. I've done a webinar on that. 100 points away from the VWAP to the high side, 100 points to the downside. Your expectations is, you know, there's going to be that type of symmetry to it. The market does have this. You know, it's not perfect, of course it's not, but there is a kind of element of symmetry sometimes with stuff. So there's a lot going on. We've got this supposed Santa rally coming. But one thing that's interesting, a lot of people say December is strong, and technically yes. If you go back far enough, the data shows that percentage-wise, it's like 68% of the time it's higher. However, I went back the last 10 years, and it was running at about, I think it was 60%, which isn't much of an edge. There's a slight bias to strength in the stocks in the last bit of the year. It tends to be more, but then last year we had a real rocky year and it was all over the place. The Santa rally tends to be kind of in the latter part of December. So if you like that seasonality, that's probably better. But you know what? I always think about seasonality as it is what it is. It's almost a self-fulfilling prophecy rather than it being something that you do want to trade off. It was like, okay, well, let's just stop, pause for a second, and we think, okay, well, if the majority of funds are positioned long, and the majority of expectations are we close on highs, that's great while the musical chairs, and it works until the music stops. Now, the music might not stop until, well, we don't know when the music's going to stop, but you kind of, that's how you think as a trader and as a retail trader. How are others positioned? What is their expectations? Now, if they're buying dips and they're trying to kind of get a big bid into the year end to kind of make close on highs and get those bonuses and stuff, that's probably the most likely scenario. However, if we get a rug pull, some unexpected news that upsets that thesis and idea, that's when you can have things change. And that's why I think the seasonality is more effective as opposed to actually going back statistically and making a decision on that. Okay, let me switch over to my other screen, which I want to share with you now. Let's get down to some business here. Trade management tactics. Do you see it? I think you do. Let's have a look. Yes, you do. Good. Okay. All right. Trade management tactics. We've seen that one before. Good old Jesse Livermore. The big money's made in the sitting. We know this by now. Trade management is not necessarily about fiddling and meddling. I don't want to get ahead of myself, but there's, we can make an active decision to do nothing, to hold the trade. And so today I want to talk about protecting the trade, scaling the trade, and exiting the trade with some kind of structure. And, like I said before, there's not a holy grail here. There's not something that is going to work every time. And you only know this by now, guys. You're in the trenches, you're in the front line, you trade. there's nothing that works all the time, but just sometimes steering the ship in the right direction is enough to accumulate edge and to kind of see the results, over the quarter or over the month, whatever it might be. So some things to kind of think about here. And this applies to us all, I know this, but just ask yourself this question. Have you ever moved a stop too soon, been pinged out, and the trade goes your way? Frustrating. Close trades too early, and it's more of a fear of giving back profits based on maybe price doing something. Frustrating. Here's one that happens quite a lot for traders. You flip-flop. In other words, you're thinking in your mind, should I close it? 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 And then maybe at a key level, you're thinking about it. Price backs off the key level, and it forces your hand and you close it, and then it just rips off the high side. That's you being driven by price. Second guess the price action only to be proved wrong multiple times. The amount of times traders say, I cut my trades early, then I tried to run them, and then it came back on me, and it always feels like you're chasing your tail. Not a kind of a cure for this, but something to help alleviate this, and really the mental side of it as well, because as traders, we've got to think what we can control and what we can't control. And I know that good traders are very, very clear in their minds that there's things they can't control. There's things they don't know, and they have to let go of control. They're in the trade. They're like, what will be, will be. The market will do what the market wants to do. This is how I'm going to respond. And having that structure helps loads. You can't control volatility. You can't control news. You can't control price direction even. You think you can, you can't. But you can control your checkpoints. You can control your if-then decisions. And what I mean by checkpoints is a model that I've come up with to serve me over the years. And you can call it whatever you like. I mean, this is just a kind of a framework that I like to use in a trade. It helps me. And listen, we're different personalities, right? You may trade in a different style to me. You may think of the markets in a different way to me. This is not necessarily going to suit you, but it might do. You might be like, hang on a second, this is something that I want to work with, and I'll make it my own. I'll tweak it, I'll adjust it, and this might help me be a little bit clearer about how I'm going to manage trades. So the checkpoint model is where, as price is moving, you're in a trade already. We talked about entries loads of times before, risk management, etc., all valid, but now we're in the deal. We're in the trade, you've got your stop loss in, and what do? Now, a lot of traders are constantly looking at price. They're second guessing things. They kind of want to walk away, but they come back and they're like, it's a little bit of both. And to be honest, I think that both extremes is too much. You don't want to be sitting there glued to price, watching every tick up, down, up, down. It's just unnecessary anxiety. And you kind of don't want to be walking away completely. Now, of course, if you're holding a trade for multiple days, weeks, and that's your style, you do. You're not bothered. But you don't want to be walking away and not informed of what's going on, because price could kind of rip off in your direction, come back, all sorts could happen. So where's the sweet spot? You want something in the middle where you're still informed and you're still judging based on price, and you're still trying to get the optimal exit you can, but at the same time not watching every tick. So the checkpoint model helps you to do that. It's a predefined moment where you reassess the quality of the trade, and before that moment you don't do anything. Now, how you deploy this is going to depend on the time frame you trade. Are you a day trader? Are you a position trader, swing trader? Are you a scalper, 5-minute chart, looking 15-minute moves, 1-minute moves, 4-hour moves, 4-day moves? Adjust it to suit you. But the checkpoints can be based on what I think are basically 4 things. So one is time. In other words, the time of day. So you might say, I'm going to check this at noon. I'm going to check this at the UK close if you're trading US market, 4:30. I'm going to check this 5 minutes before the close. I'm going to a specific time of day, right? Maybe you check in the morning, you've been holding a trade overnight, you check at 8 o'clock in the morning, whatever it might be. It's a time of day. Number 2 is duration. So this is like, okay, I'm going to hold the trade for a minimum of, let's say, an hour. If you're kind of a day trader, but you're looking for kind of bigger swings, I'm going to come back and check it in an hour. Or I'm going to come back in 15 minutes if you're a shorter trader, or a whole day. It's a duration where you're kind of combining how long you expect the trade to take to mature with when you are going to give it some attention and some focus. Because don't forget, our focus isn't unlimited. Every time you're looking at it, making a decision, you're using a little bit of resources, a little bit of decision fatigue comes in. So you want the optimal time when you're making a decision, not too much and not too little. And hopefully we'll get there in a moment. Price is exactly what it says on the tin. Hey, if NASDAQ goes up to this level, I want to be alerted. I want to make a decision. If it goes down through this low, which is a set price, I want to make a decision. If it's just a set price, just do normal alerts, right? This is another time where you can have a checkpoint where you come to make a decision. It's gone to a fresh high. I want to come in and make a decision. Structure. Be careful about this because we don't want to be, like I say, glued to the screens looking at every single tick. But we want to kind of say, okay, well, if this happens, if we breach a level and pull back, if we kind of really have an extension candle, if we do something based on price action that might maybe make a decision about how to manage this trade. So this is the kind of the core foundations of this concept is trade management, I believe, is best done at these predetermined checkpoint areas, whether you're a day trader, swing trader, whatever. Decide when you are going to look at the trade and conduct your trade management. We'll talk about the if-then statements in a moment, what we're going to look at, etc., etc. But this is the principle of the checkpoint model is I'm only going to look at price or the trade, should I say, when one of these criteria is met. Time, i.e. time of day, duration of the trade, price. And it could be a mix of the two. Fine, I get that. You could say, well, I'm going to come back in an hour, or if it takes out the low for short, for example, right? So this brings some clarity. This brings some confidence. This brings you the ability to not worry about the trade. The stop loss is in. We've done the risk management. You've taken your trade, your stop's in. Now you've got these key checkpoints, which you have to develop based on what you want to see in the time frame you're trading. Now you come in and give it your full attention. Not all the time, not some random time, but a time that's blended with the trade you're taking, and you go, right, full attention now. I'm making, because we get paid for making good decisions. I don't get paid to sit on our butts all day long. We get paid for making good decisions, and a good decision is the entry of the trade. But the decision we often forget, and we're blasé about it, I'll just take it, is the exit. We need to put all the resources we've got and the intelligence we've got and the experience we've got into making a good decision. Whether the checkpoints, do we hold it? Do we scale it? Do we trim it? Do we cover it? What do we do? And that is so key, because many people are like, oh, you know what, I'll see how it goes. And they kind of, oh, they're so tight, holding it tightly. And you don't want that. You want to be so focused. You want to take it seriously, because there's so much more alpha in the edge bits when you're trying to manage the trade correctly. So this is why I think checkpoints work. You reduce your noise-based decisions, right? How many times have you done this? I know this is something that plagued me for many, many years in the early days, the early 2000s of, hey, I've been a trader, I have a target, and then price would suddenly move back on me. Geez, I need to come out. And I'd be so nervous about price moving against me, or a little short-term candlestick pattern that it would spook me out of the trade. And this applies actually to traders who are looking for that longer term move, but then are so focused on the tape, they see a reversal on the tape and they come out of the trade. It's like, okay, well, maybe, but you're getting dictated to on a time frame that you're not actually trading. So it really helps with this, because you kind of let all the noise play out, because the markets don't go from A to B in a straight line. You let the noise play out, and then you make your decision, right? At those set points in time, the set price, etc. Slow you down, let the trade mature. We know trades take time. This is a good one. It adds some consistency to your trade management process. I think many traders, their trade management process is either non-existent or very, very loose. And I think that and I get it, right? No, we don't know what the market's going to do. We have no idea where it's going to go. We take the trade. We hope it's going to go in a direction. Hope's okay. As long as we're not trading on hope, it's okay. Of course, we all hope our trade work out well. Nothing wrong with that. I want to trade based on that, but it's the normal human emotion, right? But we don't want to overthink this. We need to add this consistency so that we do the same thing again and again and again. That's how we improve, because we make adjustments, tweaks, just like we do in our trading plan. Keeps you aligned with the original thesis. If your idea is to close at highs, then you're going to align your checkpoints with that. I bought this low. I think it's the low of the day. Where's my checkpoint? I want to come back in after an hour and see if we pulled off that low. We've held and price is trading if it trades well. I want to come in an hour before the close. I want to come in if we take that the high. these are all checkpoints that are valid for the trade and keep you aligned with the original thesis, rather than sitting there going, oh, it's rallied off the low. Great, I'm right. Oh, it's coming back. It's coming back. Oh, it's coming back. Oh, it's a double top. And you're kind of so myopic onto the short-term price action that you lose the bigger picture of why you're in the deal in the first place, giving these trades room to mature. Okay, so let's talk about the decision flow. So really, there's only 4 things we can do. There's 5 if we cover adding to the trade, but we don't talk about that. It's a separate topic, separate skill set, I think, to develop. So there's 4 things we can do. And these might sound, well, yeah, no beep, Sherlock, right? Yeah, okay, Mark, you're a genius. But I think being intentional about these decisions, each decision is an intentional decision. I think that serves traders so much better than just, my default is this, It's like, okay, you've got 4 decisions to make, or 4 decisions. You're either holding the trade, you're either scaling out the trade, you're moving a stop, you're exiting. You might have a blend of the 2. You might scale out some, move your stop. You might hold your trade and move your stop. But that's really all you can do. And so as you reach your checkpoint, you should say, what am I doing with this trade? Am I actively making a decision to hold it? Here's why. Am I making a decision to peel some out, cash flow the deal, let the rest run? Why? Am I moving the stop? Big on this. It screws up. So many of us move the stop. Oh, I want to protect profits. And all you're doing is moving stop into noise and getting pinged out. And we know what happens. So again, it's a structured place to move the stop. Some sort of price actions happened at this checkpoint or leading up to the checkpoint that makes you want to do this, or you exit the trade. And you might say to me, Mark, listen, I want to hold my trade to target. That's fine. And I agree. And there's nothing wrong with that. You've got to stop, you've got to target, you have one or the other. But we both know that sometimes price gets close to target, and now the risk reward dynamics of the trade have changed completely. You might be, choose some arbitrary numbers, 10 points away from your target, and your stop might be 90 points lower. Now you've got a really skewed risk reward ratio on the trade. And so, yes, at the beginning, you say, I'll stick to my trading plan. I want to hit my target or my stop. But as that gets closer and closer to your target, the trade's not the same anymore. The dynamics have shifted. And so this is where the kind of checkpoint comes in, where you now adjust it based on the new patterns that revealed itself, the new price action that's revealed itself, because no one wants to wait and there's 5 ticks to go and it happens to be, it's been consolidating there for ages and it's going to be a big gasp for it to go up and you've got to have your stop right down. It doesn't make any sense, right? You want to do something with that. Do you peel some out? Do you move your stop? You want to manage it based on the price action that's developed and the trade you're trying to achieve. And by all means, stick to the plan. Let's not deviate from the plan. But we know that the markets change after you've been in the trade. They change their character. They change what they're revealing to you. And so we should adjust and adapt from that. And yes, sometimes that means, my target was here, but we're trading so well and so cleanly. I'm going to put my target up here, but I'm going to manage it at certain points along the way. So let me give you an example here. If you guys can see that on, I think if I click on it and make it bigger. There we go. That's better. Okay, so this is the Nasdaq from a few days ago at that big sell-off. Just an example, right? I just want to highlight how you might manage this if you were trading. So if you're looking to jump on the short side, which many people were on the kind of pullback, short the first pullback, it's kind of bear market trading 101. Although we're in bear market, but heavy down day trading 101. Rallied up, and imagine you were shorting on this first kind of red candle, just for hypothetical sake, right? And your stop was going to be above that high. Pretty textbook stuff so far. How would this checkpoint thing look if you were doing this? Well, let's look at three ideas for checkpoints. One is price. Now, I don't know about you, but I want to see what price had done and how it got to that level, that prior low. Now, this is when you walk away, or you're at least not looking at it, thinking. You're in the trade. It took 20, 25 minutes, 30 minutes or so. Bing, checkpoint 1. Price. How does it trade through that lows? Now, for me, that trade's really good. If I'm short and I've just seen it gone straight down, it's not like it's sat there just pinged through it, done. It looks pretty weak, right? So that your decision might well be, I'm holding this trade. I'm going to move my stop a little bit, perhaps, because you don't want it to kind of double bottom. But you're not thinking. The reason you're doing this is you're not thinking, oh, what do I do here? Oh, green candle. What do I do here? What do I do here? Oh, wick. You're not thinking that. You're thinking, hey, the play is that I think we're going to close at lows, or I think I don't know where we're going to go, but I want to get short as super weak. Again, it's okay not to know where the price is going to go, but we want to be smart with it, not just let it run and be loose. So our first checkpoint might be price goes through lows. Let's review. Do you want to hold it? Do you want to move the stop? Do you want to close it? Do you want to peel some out? Again, it depends on your thesis and idea what you do, but that's an idea. Next might be a duration. I want to hold it for an hour. Okay, so an hour later, you check again. So you check on there, you check on your price, you check on an hour later. How does it trade? Pretty good. If I'm short from here and it's holding below the current day's low and flagging below low, I'm well happy. I'm like, you know what, nothing to do here. Fine. I'm just going to leave it, see what happens. And then maybe you check again just before the closing bell, and that's your checkpoint 3 time. You check at the closing bell, and you say, you know what, I think there's follow through on day 2. It's closed at lows. I'm going to hold it. For example, maybe you trim some because you don't want to take some overnight risk. So maybe you peel some off, maybe you tighten the stop, maybe you become a little bit more defensive. But you see how, and I've got an example at the moment, it didn't quite work out as the way you wanted, but you see how much calmer that is to trade. You've done all the hard work, you've made a decision, you've got short. Great, whoopie-doo, you're right, you've done your job as a trader, give yourself a pat on the back, but you're not looking at everything, second guessing and worrying about what's going on. Now, if this had crept back up and closed back up here, you'd have gone, you know what, I'm done. I'm not going to check the trade, I'm going to close the trade. And fine, you wouldn't have made so much money, maybe lost a few points or whatever it is. But the point is that we over what's the word I'm looking for? I think overemphasize our ability to read price, right? We think we're better than we are sometimes. We think that we'll see the reversal. We think we'll see something that will tell us the market's going to do this. And in reality, we're not that good, right? We're not that good. There's so much noise out there, so much chopping about, so many algos doing stuff. They're going to spook us, especially when we've got skin in the game, when you've got position on, especially if you're swinging a decent line, you've got a decent sized clip on it. You're going to have a different emotional response to stuff. And I think that going back to kind of the first couple of slides and something, Jesse Livermore talks about loads, at some point you've got to give out control and go, I'm short, I think this is weak, I'm just going to ride this until kind of the checkpoint tells me that I shouldn't be holding this anymore. And that may be giving back profits, but that's okay because I can't control that, but I can control my decision point. So the example here is that you've got these different checkpoints that you might use and look at if you were kind of trading in this manner. All right, so what are we looking at these checkpoints? So if you're like, you know what, that makes sense, man. I can come up with checkpoints for my specific trades. I'm not overthinking. I'm not constantly second guessing, and I'm not just leaving it and hoping, that things go my way. So some things you might look at are your if-then logic. And what I mean by if-then is like, if this does this, then I'll do that. In other words, if your typical daily range has already been hit and you think it's a normal type of day, and you're like, well, that's actually moved quite a lot quite quickly, then maybe you trim some. That's when you scale some out because your brain says, hang on a second, we're a normal type day, I'm right, I've come in an hour later, we've already done the full range in the day, you know what, I'm going to trim some off. So that might be something you do. And again, all these things are examples. You come up with your own, if you have some experience in the markets, you make your own commercial decision here. Another example might be, hey, we rallied up, we came under VWAP, then we reclaimed it. I'm like, that trades well. That's a price action tell that suggests, hey, sellers didn't step in and we didn't get another leg lower. We've actually reclaimed the highs, we've reclaimed VWAP, we've reclaimed the open. I'm going to hold it. I like that because that sets up more fuel for the rally. And then so thinking again in terms of price structure and saying, okay, well, I'll hold that. Another example might be, hey, I was long and we faded off into the close. You know what? I don't like that for a day to follow through. That's not the close I like. It's not traded well enough for me. I'm going to close the position. Key level reject, move stops. You get the idea. You've got a structure of how you're going to trade things. So this example here, I don't think I need to click on this. Let's say you bought this breakout here, classic afternoon breakout, and let's say your checkpoint was, I'm going to come back at the end of the day. Okay, I think it's going to close on highs. I've got my stop in place, let it run. and I'm going to look for kind of a multiple day move on it for whatever it might be, maybe a value positioning, you might see that pull off of the close. And one of the things I said is like backing off the close. And I'm using this as an example, right? And go, you know what? I don't like the way that trades. That's not that great. I'm going to close it. In this case, it wouldn't be the right thing to do because it actually rallied up overnight. But this is the point. It's like, okay, well, figuring out what you want to look at, when you want to look at it, is so much more manageable and repeatable process than just hoping and going, well, I hope it'll be the right time. I'll be lucky and I'll see the turn, or whatever it might be. So what's important? So what are the more things we're going to look at? Clue one is distance from key levels. So we've talked about key levels before, and I think you know this is that, how price behaves relative to current high, current low, prior close, the open, VWAP, all the things that everyone already knows. How does it, what is the distance away from it? Are we quite away from the open? Is that strong? Has it come back and tested? Are we near the high? All this is stuff that, you know this, and if you're kind of judging price action on a chart and you're making a commercial decision on whether to take a trade or not, this is all stuff you already do. So you just layer that skill set into your management and say, okay, how does it trade? What if I was about to initiate a trade here? Would I want to be long? Would I want to be short? Would I be okay with my long? Just running through that in your mind. So distance from key levels is super important. Range expectations, talked about this a little bit earlier, but I did a whole webinar on this, by the way, ATR, and I think it's a super useful tool. Is okay, well, hang on a second. If you bought, let's say you bought the opening range breakout, right? And your expectations for the first hour are 100 points based on research you've done, analysis you've done on the market you trade, which we kind of should be doing. If you come back half an hour later and it's already done your expected move, then you probably want to trim the position or close the position. Like, you know what, I'm going to tighten the stop up. It's done more than I expected. I'm going to do something about this. If it's only just getting going, okay, I'm going to leave it. If it's massively rapid expansion, you've done a huge ATR move, more than normal, maybe that's when you close the position. You go, you know what, actually, I was looking for a close at highs, but it's done so much. The move is so big in that opening drive. What more am I going to get unless it suddenly creates into a massive monster trend day, which I don't think it's going to because of X, Y, Z. Then fine, I'll close the trade early. That's okay, because you're calibrating your trade management to the conditions you're given, because then you took the trade in the first place. It didn't reveal that. Look, a nice opening range breakout trade. You just took it like a good boy. Then all of a sudden, it's just ripped off at the open. That first hour, it's done a daily range. Thank you very much. I'm a trader. My job is to kind of capitalize on these moves. I'm coming in, my checkpoint, done. I'll close the position. So, these are the type of things that's to work through in your mind. Another thing to think about is your range quality, let's say. So how does price mature? Is it grinding higher? Nice acceptance of price. If you're long on a grinding trend move, it's brilliant. No heat, nothing. You come in, you check after an hour, you check at the UK close, you check at the US close. You're like, you know what, this looks great. It's closed at highs, ground higher, broken out from my structure. I'll hold it. Or maybe you bought lows and it's grinding high. You make the judgment. How's it going to blow off top? In which case you go, hang on a second, it feels like a liquidity event. This, I happen to be in it. You don't want to catch it perfectly. But again, your checkpoint will allow you to say, I need to trim this. I don't want to look a gift horse in the mouth. Yeah, I want to hold this trade, but ultimately it's behaving like it's the last leg. And I don't want to sit through multiple hours of pullback. That's a trade I'm going to take off. Flag, impulse, you get the idea. It's looking at how prices has moved. The other thing is like your candlestick stuff. So, and this is things that you already know. If you've had these solid bars, boof, 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 on a 5 minute candle off a 5 minute chart, should I say, off lows, that looks great. If you come in 20 minutes later after buying a double bottom and you just see 5 minutes solid green, 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 you and I both know that's lovely. You're like, thank you very much. I ain't touching this. This is perfect. I expect a little bit of a retracement, a little bit of a flag, and there's going to be probably another leg in. I'll move my stop up below that ignition bar, initial ignition bar. Otherwise, I don't need to do anything. Versus price has gone up, wicked, pulled back, grinding lower. You're like, oh, do you know what? That trades like a rotational market. I might have some profit. I'm definitely going to protect my trade here. I bring my stop up, or I'm going to cash flow the trade, take off half, leave half to run. It's very different, and we know this. And this is why this checkpoint model is so effective, because you're seeing the new chunk of information as it comes in, you're looking at it going, okay, what's happened? Hey, we faked out here, we've done this. Oh, we ground. Oh, wow, acceleration, we've done this sort of move in an hour. Or, you're looking at the new information that we don't know when you take the trade, and then you're making a commercial decision what to do with the trade with that new piece of information. And then next checkpoint, the next checkpoint, the next checkpoint. This becomes how you monitor your positions without over monitoring them, without second guessing, without panicking about things. If you're a panicker, you're a meddler, then this is a really good way of doing stuff. And then you've got time things that are important, right? In the close, US Open, lunchtime, noon balloon type stuff, overnight gap risk, etc. Example might be, here you go. Here's a kind of worked example. Let's say you were you short the opening range breakout on DAX, right? So 15-minute chart breaks finally. You then say, you know what? I'm going to check it every hour. So your checkpoints are hourly. You said, I don't know where it's going to go. I'm going to manage it based on what I see. So after an hour, you're like, oh, you know what? Hasn't really broken the VWAP. It's not great, but it's not. I don't need to do anything with this. My stop is still above the high. Fine. Hour later, you come and you see this. You're like, oh, that was a bit of a rally off the low. But hey, we've pulled back a bit. I might bring my stop here to protect this because this could be a little dip that we push back to VWAP. I don't want that. So you see how you're managing it, but you're not getting caught out in every little thing. And then an hour later, you come back, you go, oh, okay, this is looking great. We're holding at lows, a little flag here. Maybe you go, actually, we've done a full ATR move or expected move. I'm going to trim some of the position. Again, this is up to you, but it's so much calmer and enables you to hold a trade that's working without worrying. Hour later, you're thinking, great, you know what, maybe I'll trim some, maybe there's support there or whatever. An hour later, you're probably out of the position because you know what, that looks like a reversal there. I'm out of the whole lot. You get the point, I think, is that this is an example of your checkpoint being a specific duration. Every hour I check it, otherwise I let it run. And having this confidence to be able to do that just helps so much, man. It just helps so much with the way you manage trades and stuff. So let's talk a little bit about partial profits. So scaling out, taking partials. I think some people say, listen, you shouldn't be taking anything off the table. I disagree, right? Sometimes when I want to cash flow the trade, I think the highest probability move has happened, but I still want to be long. Let's say I'm long. And so you might see a big drive. You're like, hey, that's what I thought. I thought we'd break out that flag. We've taken out highs. Now we're sitting here. Now you go, I don't quite know what we could do. We could drift back. The likelihood is we continue. But the meat of the trade's done. I don't want to close the whole thing. That's a perfect time to scale out. You cash flow the deal and you say, you know what, I leave the rest to see what happens. I think that's okay doing that. A lot of people say, oh, no, you shouldn't be doing. I think that's okay. As long as you're not taking profits on the first little impulse, unless that's your idea, then there's nothing wrong with making a commercial decision and saying, hang on a second, we're in a full range of day. We've had a big move, really explosive move. We're sitting at this massive resistance level. The chances are we drift. It could take another day to resolve. Do I want, what am I gaining from here? Well, why not cash flow the trade and trail some, trim and trail. And that's where you got to think as a trader is, hey, what's happened? Where are we? What are my expectations? What are the roadblocks? And looking at the trade rather than the stubborn lens of this is my complete existing strategy and this was my setup, this is why I take it. Like, okay, the picture's changed. The picture's completely changed now. And maybe that means I need to take some off the table. So it's just something to consider. And when you don't consider not taking stuff off the table, this is when you hold stuff and say, price is aligning with my idea, my thesis. You've had a clean breakout. It's grinding higher. It's a range expansion day. Volume's picking up. Market's holding highs. All this type of stuff. It just trades well. And again, this takes some time and experience. I get it. Some judgment, some discretion. But sometimes you go, you know what? This is trading exactly as I want it to. I ain't touching a thing. You might move your stop up a smidge, and maybe you even don't. Like, I don't want to. I'm happy to leave this and let it go. And this is where you kind of, if you can build this muscle of being able to look at the checkpoint methodology, if you like, and take all those different information pieces in, that's when you really grow as a trader. That's when you say, you know what? I don't like this trade so much. It's not trading as well as I'd like. I'm cutting it and being fine with that. And it's not based on FOMO. It's not based on anxiety or emotion. It's based on you looking at a new piece of information that's developed since you took the trade or since the last checkpoint and making the decision from that. Stops, being careful, of course, not to kind of tighten things too much. The structure supports like a stop movement. You've done stuff. One thing I kind of really wanted to highlight here is just be careful when moving stops. It's so tempting to move stops. It de-risks the trade or move it into noise. I think you've got to be very, very careful about moving stops. It's one thing to kind of look at the trade and hold the trade, but I think the decision to move a stop is a very considered decision. I think it screws up more traders than it benefits, because the whole theory is, I move my stop, I do this and do that, and fine. You've got a big move and you're like, I want to protect this complete reversal, then fine, do it. But still, I would always err on the side of it being wider than tighter. Only with this caveat is that if you are really close to your target, you're like, you know what, it's 50-50 here. I'm prepared to give back 50 pips to make the 50 pips on the target. It looks all right. Yeah, I'll tighten my stop right up and see what happens. And if it comes back, pings you out, like shrug your shoulders. If you get the last bit of juice from the deal, then great, you feel good about this. So just be very, very careful about moving stops, because it's so simple and easy to just move your stop, think of moving your stop. But you can ruin such a great trade, because don't forget, if your trade idea is to kind of hit a high level or a target, there's going to be noise along the way. Now, it's great when it goes from A to B and it zooms off and you go, thank you very much, rub your hands and you go, beautiful trade. But very often you're going to get some noise in the midst of that bigger move happening, whether it is intraday, whether it is multi-day. And so being careful not to fall foul of or move it into noise, move the stop into noise. So in simple terms, let's run through what we're covering. Checkpoints first. I think that's such a good framework and structure to have. I will review my trade at certain checkpoints, not all the time, not some random times. It's like, okay, and it's aligned with your thesis and idea. 2, your if then rules. So what are you looking for specifically? Gave you some ideas there. Where is it in relation to the VWAP, the close, the open, the high? Not necessarily in relation to your trade, because the market could still kind of just dance around a little bit near your entry, but you still like it. You're like, okay, it's not gone immediately, but I still like it. So being very careful not to have the anchor bias, where you're anchoring the price action to your trade. Anchor it to what you think other people are looking at. Is it the VWAP? Is it the prior day's close? If it's been a gap, is it the low? You know, just making that decision, ignoring the noise. If there's structure, you make some decision to adjust. Partials, the cash flow in the trade, not because you feel like you're worried about giving stuff back. It's just a considered decision. Hey, I think the probability now of it pulling back, if you're long, is much higher. So I don't want to have that full risk on. I want to take some off. Or you might say, you know what, this is great. I don't care if it pulls back, because I still think higher time frame we break and do this. That's fine. You base on your thesis. Stop should move with logic, not fear, of course. And asking yourself the question, listen, how does it trade? If it's trading well under the parameters that you use to judge if it's trading well, hold the thing, right? Just hold it. And hopefully this checkpoint method helps you hold stuff. If you're struggling to hold trades, being able to assess it at these key points is much of a calmer way to do it. And your mind's screaming, take profits, take profits. You're like, no, it's fine. I'll just hold it for another hour and I'll review it. And that's how you kind of stretch yourself in your comfort zone to hold trades a little bit longer, a little bit longer, a little bit longer. And you have to hold a few decent trades, and you're kind of sold. And you go, you know what? When the story's right, when price is acting right, and I'm looking at it clinically, and I'm looking at it logically, and I'm not acting out of fear or emotion, I can get on some really big winners. And if you do that, it only takes a few, and you go, okay, well, I need to just kind of get this in check now, because I'm good at judging the price movement. I'm good at judging direction, but it's tightening my stop too soon that's ruining the trade, or it's fear of giving profits back that's ruining the actual trade. I can unlock a really decent edge here if I just allow myself to calibrate to the conditions. Okay. Whew. Hopefully that's helped and made some sense. Next week, guys, we are on Monday the 8th of December, not Tuesday, at 7 p.m. So our normal time, but it's going to be the Monday. I'll send out an email to confirm that. And we're going to do the 30-day AI challenge for traders. You ready for this one? This is to really lock in. I want everybody who's interested in becoming a better trader, leveraging on AI, using that This is the challenge. My challenge for you: put together this kind of ideas and drills and stuff. Bring some of the things we talked about a couple of weeks ago, stuff that I share in the daily emails or ideas of, okay, run with this for a bit, and you'll hopefully at the end of the 30 days see where AI, ChatGPT, Gemini, whatever you use, plays a big part in your trading, and more importantly, be ready for when the big breakthroughs happen and you're in the right place at the right time for stuff. So that is next week, but it's on Monday, not the Tuesday. So just be aware of that. Okay. And by the way, thank you, of course, to the good guys over at Pepperstone for letting me talk about things like checkpoints, managing your trade, and things I think are going to help you with your trading. Okay, if we've got any questions, happy. Oh, there's quite a few. You said had that shrunk down. Oh yeah, did you guys have? Don't forget this one. What is it actually called? It's called With New Commentary and Insights on the Life and Time. So, there you go. Annotated edition by John D. Markman. That's that book. Good evening. Okay, good. Okay, let's get to questions. Good evening, Mark. Good evening, Royston. Seda says, can you ring me on, I won't say your number, or email me. No, I can't, but you can email me. If you email me, reply to my daily email, I'll happily reply to you there. Gary says had to go early. Thanks as always, Mark. Appreciate you, Gary. Anthony Romanowski, great name, mate, says, hi, excellent webinar this evening. Thank you. I'm a trader who works from home in a small town. It can be lonely. Do you have any recommendations on places where I can talk to other traders online or in person? It is difficult, Anthony. I get it. It is difficult. It's, you feel like you are, and the thing is, you don't realize the emotions you feel everyone else feels, and you think it's just you. Why can't I do this? Why can't I stick to my plan? Why do I feel like this? And actually, when you speak to other traders, you realize. I have got a trading community. It's closed at the moment. We have trading pods, and it's working very, very well. I'd love to say come in, but we've locked it down for the time being. I'm trying to think of any other communities. You can check something like I don't know if meetups still do kind of trader meetups. I'm trying to think off the top of my head if there's any really good sort of community of traders. If I think of anything, I'll let you know. But I think it's just being open-minded and making contacts with others. I know it's difficult. Maybe social media, going on some forums. Maybe years ago when I was on the forums in 2001, 2002, I made some great trading friends. Different ball game now, but you start to see who are the idiots and who are the good guys. Is that too old school forums now? Probably, or anywhere traders hang out online and kind of filtering through and saying, you know what, maybe sending someone a DM or message saying, you know what, I trade this. Are you interested in having a chat? That's maybe your best bet. Okay, Anthony Valone, how you doing, buddy? Happy late Thanksgiving to you. Great point on balancing screen watching and stepping away. I found that sitting with every tick for a while actually helped rebuild my resilience so emotions don't override the chart. Once that's solid, I switched to setting alarms at key levels so I only step back in when it's time to manage the position. That's a good point, actually. Yeah, so Anthony's saying here that he almost seasoned himself to be able to put his feet to the fire, and it said, hang on a second, do you know what? I want to be more resilient, so I'm going to do more of what I'm uncomfortable with, put myself in discomfort so that I can be more resilient. That's great. I think anything where you have a drill-based mindset where you say, hang on a second, I'm going to do this, but my outcome is X. That's not how I want to trade, but I want to season myself to doing that. Then I think that's a good idea, Anthony. Yeah, thank you for sharing that. Alison says, this was so helpful. Thank you so much, Mark. Appreciate you, Alison, as always. Edward says, if you review your trade at CPs, would you not review your stop loss when it has been hit? Does it not suck to be pinged out on a ping bar? Would you not review your stop loss when it has been hit? Yeah, I mean, if your stop's been hit, of course, you're out of the trade, right? You have nothing to review. Well, obviously, you review it later and you do it in your journal and stuff, but the trade's done. This is more like if you're in the trade, and you're looking to manage the trade and move the stop or take some partials or whatever it might be. And your comment here, does it not suck to be pinged out on a pin bar? Yes, it does. It absolutely does. But something you can think of here, and this is why I'm always more of an advocate of wider stops. People hate it, but honestly, I think it's a much better way to trade. Is think where the pin bar could go and still be a pin bar. Of course, it's not going to be perfect, but if you look and go, hey, if we wick through that, and allowing for that, I'm always an advocate of a wider stop, smaller position size, let the trade mature more. I think that serves traders so much better than trying to be too aggressive with the stop, because the environment we're in now in 2025 coming into 2026 it's run by the institutional algos. These guys at Jane Street and stuff are making huge amounts of money just going up and up and up. Citadel, Virtu, all this stuff, right? And that's all because they're trading algorithmically intraday stuff. And so I think that, knowing that and saying, hey, hang on a second, of course you never know for sure, and a pin bar can always ping you out. But I guess what I'm trying to say here, Edward, mate, is if you have your stop a little bit wider, position size a little bit smaller to accommodate the extra width, I think that works out in the wash over time, personally. Felix says, hi Mark, very timely topic for my trading, thanks, appreciate that. Felix, I was short the open on NQ and had a nice setup going until it all made a V-shaped reversal and I got out with a big zero, trailed my stop to break even. 2 questions on that. What do you think about ATR based trading stop? And question 2, how do you personally decide whether a mid-morning counter trend move is a retracement or that dreaded V-shaped reversal? Hindsight, of course, is always very easy to tell. Yeah, hindsight, we've always got to be careful of hindsight bias, and I'm always a big advocate of saying, what did it look like at the hard right face of the chart? Very different than further on. Trading stops question, not a fan, not a huge fan. I prefer this method of, at a certain period of time, I will judge where to put the stop. I think the problem with trading stop is there are upsides and downsides, of course, personal opinion. If you have a real kind of extended move, you prepared to give back quite a chunk for it to consolidate and maybe go again. And the problem is the trading stop is it kind of attaches it up. Now, if you come into the last, here's a way that I kind of, maybe this visual will help. And I always think about this. A trade has a takeoff and it's getting over that initial entry and just getting into the next sequence of price. So maybe you get a rally off that low, then it consolidates. That's the trade taking off. We've sort of a plane analogy here. Then you've got the cruise. The trade's kind of doing its thing, chugging upwards, consolidating, backfilling, and there's not much to think about there. It's like, okay, well, it's in the cruise, we've got not much to do. Let's just see what happens. And then the landing is where it's approaching areas where you perhaps want to consider taking a trade off. It's a target or it's come back to us. That's where you kind of look a little bit more, or they give things a little bit more attention. So looking at these checkpoints, I think is better than the trading stop. However, what was I going to say? As it's coming to the landing, so let's say it is coming into a zone where you think, hey, you know what, I want to be out of this trade now, then I think an ATR-based trading stop is great. If you're an extended move, you're like, this could really, really rip, then I'll just you could ratchet the stop up there and use an automatic trading stop. Personally, I don't like it on the normal trade. I want to make my own judgment call on that. Now, the second question of how do you decide whether a mid-morning counter trend move is a retracement or the V-shaped reversal? You don't know. One thing I would say, Felix, is, is that short really in alignment with the current sentiment we had? And that's the danger of shorting. And I'm not saying don't short, but that's the danger of shorting in a bull market. Even though I know we've come off highs and we've rallied the past few days, the strength there is you've got to be sharp, man, because the thing can rip back on you very, very quickly. And so if I'm ever shorting in bull markets or environments, I'm so keen to take profits. I'm happy for it to carry on without me because I know that these things can happen. So one thing from a commercial perspective, Felix, is if you are shorting against, or if you are going against the prevailing trend, then I would be extra quick on my profit taking. Any sign of it going again, I'm done, because that's how the trends continue, as you kind of have these downdrafts and push up. If you were long, slightly different. Might be like, okay, well, I'll let this kind of play out and it might sort itself out. Just a kind of, I think, a good rule of thumb. Where can I find the ATR lesson? George Noble says. George, if you go to my website, which is tradersmastermind.com, and if you go to learn, maybe resources. I can't remember what it's called now. I should know this. My own damn website. Anyway, there's a section there, webinars. If you scroll through, all the webinar recordings are put on there. And there's a couple of ATR lessons on that. We should watch those at your leisure. Alex, that's say master to you, pal. Anyway, we can watch these webinars. Yeah, go on tradersmastermind.com. They're all there. And I think sometimes Pepperstone will put them later down the line on their YouTube channel under a playlist. I think that's how they do it. But I've always got on my website anyway when I can. When the editor has looked through and made sure I've not said anything silly and put some nice graphics on it. Thank you for the useful webinar, Mark. Clearly moving the stop is something I need to work on. Beth, it's a common thing for so many traders, moving the stop. And here's something is something for you. I know we've gone over a little bit of time here, but this is a good question, Beth. Thank you. Try not moving your stop for a period of time, just leaving it where it is. You know, the decision is not move my stop. It's either take my trade, my profits, take partials, and even not that. Close the trade, leave the trade. And you'll be surprised at how often the trade goes in your favor and keeps going and keeps going and keeps going and keeps going. And moving the stop is a detriment to your edge. And only when you're very, very certain you've got a good handle on things, start to think about moving the stop. Because the moving the stop is just fear of giving back profits. And, you know, maybe break even at worst. Like at worst, go, okay, I'll move my stop to break even when I've got really good kind of unrealized and it's break even or nothing or profit. I think that's a better way of doing it rather than trying to add an extra, you know, an extra variable into the trade success rate of where did my stop go? Because I bet very often you move your stop, it gets pinged off, it goes. And that's purely from a desire of not wanting to give back profits. Let it go. Let the trade go a little bit. Say, at very worst, bring it to break even. Go, you know what? If it comes all the way back, so be it. But you'll find that if you're right and you start to prove your edge and your efficacy and your ability to read that medium-term price action or short-term price action, then you go, okay, you know what? Maybe I don't need to move my stop. It's not serving me at all. Paul says, thank you as always, Mark. I appreciate your webinars and daily emails too. Thanks a lot. Thank you, Paul, for reading them, and thank you for coming this evening. Thank you, Alex says in response to the question, and Edward says, thanks, Mark. Should have said conditional stop in the previous question. Okay. Thank you, ladies and gents. We'll call it leaving there. Again, we're on to Monday next week, but I will tell you all in the email. If you're not on my email list, then you should be, because I share some, I think, good insights. Occasionally make you laugh, entertain you, and educate you maybe. But I always appreciate you guys coming here. I know you've got other things you could be doing. And so hopefully I've given you something to think about, ponder, and maybe help and improve your trading. That's always my objective. So if I've done some of that tonight, then good, job done. Thanks for your question, guys. Appreciate you all. Take care. See you next Monday. Bye-bye.